According to the recent statistics that I have pulled up, Americans move on an average of 11.7 times during their lifetime. Let's just round it to 12. Now that comes out to moving about every 5 years. I don't know about you, but I have never enjoyed moving. So wouldn't it be great if there was a tax benefit for doing this to make you feel a little bit better about all the work that goes into it? Well, today I'm going to tell you about something that you can take advantage of that will help you earn tax-free money, which is the best kind to earn. For taxpayers, there's an exclusion that applies to when you sell your personal residence. This has been around for a very long time, but a lot of people either forget about it or they don't realize that it exists. If you meet the requirements, which really are not that difficult, then you can exclude, meaning you do not have to include the earnings from the sale in your taxable income. Now, for single taxpayers, you can exclude a gain of up to $250,000. For married filing joint taxpayers, you can exclude up to $500,000. Now, if you're married but you decide to file separately, then that exclusion would be $250,000 for each taxpayer. So let's pause there and let's talk about what that means. So the gain is not your proceeds. That is the difference from what you sell the house for less what you actually paid for the house. That would be your gain most of the time. Now, of course, there's exceptions. For instance, if you had rented out the house for some of the time and you took some depreciation deductions, or maybe if you used part of the house for your home business and took deductions for it there, then that could modify the gain or the portion that is excludable. Otherwise, it's a pretty straightforward calculation. Now, in order to meet the exclusion requirements, you will have had to own the home for 2 out of the last 5 years, and you will have had to have lived there as your principal residence for at least 2 out of the last 5 years. So this takes out vacation homes if you never used it as a principal residence, and it takes out rental properties if you had it rented for the entire time and you didn't live there. Now, if you had rented the property for some of the time during the last 5 years and you lived in it for at least 2, you could still get the exclusion, but that exclusion amount may be prorated to account for that. For instance, if you own the home for 5 years, you lived there for the first 2, so you meet the requirements, but then you decide to move out and you rent it for the next 3, well, then your exclusion is going to be prorated such that you get benefit for the 2 years you lived there, but for those 3 years, that's not going to be part of your exclusion. So if you were married filing joint and you had up to $500,000 that you could exclude and your gain from the sale was at least $500,000, well, you would be able to exclude 2/5 of that, or for the 2 years that you lived there. So that would be a $200,000 exclusion. So you can still get the benefit even if you rented out the property for some of that time period, as long as you also met the 2-year principal residence requirement. Now, if we just do the simple math on it, for married filing joint taxpayers, if you were able to maximize the $500,000 exclusion every time you moved, and you're expected to move at least 12 times during your lifetime, well, that's $6 million of income that you could exclude that you're not taxed on. And if you're single, well, that's still $250,000 if you can maximize it times 12 times moving, that's $3 million tax-free. I actually had a client that did this and they maximized the exclusion every time because the market that they were in and the size of house they were in, they pretty much sold a house every couple of years after living in it, and they would move on and upgrade into another house, and he was able to max out those exclusions. So he was taking advantage of this tax break. And this is something that you can also do. On the other hand, I had a client that had come to me after they decided to sell a house, and they barely missed this requirement. So they had lived there for a year and like 11 months or something like that, and they didn't tell me they were selling the house until after it was too late. So I told them, hey, next time you need to talk to me before you do any major transaction, because all you had to do was delay the sale by a month and you would have excluded the $500,000. Instead, they missed out on that exclusion because they didn't go to their tax professional ahead of time to plan for this. Because remember, while I want you to understand some of the basics so you have a heads up of the things that you need to bring to your CPA's attention, a general rule of thumb is just to discuss pretty much every major transaction that you're planning to have with them beforehand, because oftentimes, one, it's too late when it's done. There's very little tax planning that can be done after the fact. But number two, you never know what potential tax planning opportunities there are because it's not your job to be a tax professional. So I hope you found that useful and you can use this to increase your wealth. I'll see you guys in the next video.